You know, as long as I don't believe it, it's great, because I have a saying, it's great to create an image, but when you believe it yourself, forget it. You know, when you mention the word risk, I was once asked at a dinner, what is responsible for my success? So I said 3 4-letter words that end in K. One is luck, and I described how I got my first job on Wall Street as a trainee. One is work, and that's obvious. And the other, and I looked around the room, and everybody was waiting, and I said risk. So you caught the right word. Thank you. You know, technology, I'm going to spend a few minutes talking about the changes that are going on Wall Street today. Because while I live with them every day, very few people know the changes and how it will affect the future. Technology is changing and has changed the way Wall Street does business. Almost every day there is an announcement as to whether or not the stock exchange will go public and in what form. And major investments are being made in the ECNs, or electronic crossing networks. These are new trading systems. So I'd like to take you back into the history of what's happened and the way things have changed during my 31 years since I made the stock exchange co-ed. I can say that the technology is changing, and it's changing daily, and it's moving at a record pace. Up to about 15 or 20 years ago, the stock exchange had operated in the same way that it's operated since the buttonwood tree. An order was received upstairs. We wrote out the ticket or called it into an order clerk who sent it down to the floor, where a clerk would write out the order, hand the order to a member of the New York Stock Exchange. Every order had to be executed by a member of the New York Stock Exchange. He went, there were no she's at the time, he went to the post where the stock was traded. And each stock had one specialist. It was only traded at one post on the New York Stock Exchange. And they would execute the order. If General Motors was 68 and an eighth a quarter, if you wanted to sell, you sold it at 68 and an eighth. If you wanted to buy it, you paid a quarter. Then the process was reversed. The member would take the order back to the clerk, who would either call or wire it upstairs. It would then go to the broker who took the order, and they would call the customer. Every order was executed by a member of the New York Stock Exchange. The independents were called $2 brokers because they got $2 for doing that. Whether the execution was for 100 shares or whether the execution was for 200,000 shares. So that's the way it used to be. The first electronic change came with DOT, or the direct order turnaround. This was the first electronic order handling, and originally it was for small orders, 2, 3, 4, 500 shares. And that order would be typed in. It would go directly on an electronic machine to the specialist post, be executed automatically, come back, and it bypassed that whole process. This happened maybe 20 years ago. And that was the first time that electronics played a role in the way orders were handled. The system was then expanded so that you could put larger orders into the system, and the institutions could use the system. And the brokerage firms placed machines, the electronic machines, in the institutions so that they could place their own orders. And I remember at first when one of the firms placed one in PERS, which was one of the first machines, and that's the Personal Employees Retirement System of California, which has about $200 billion in assets. During the same period of time as these machines were starting to take over, and they were very efficient, derivative trading grew. And if you remember, it expanded rapidly, and these machines were then adopted for what they called program trading. So an institution could put in all their oil shares, sell them, and at the same time as the orders were being executed, if they wanted to shift their investments from oils to chemicals, for example, they would buy stocks simultaneously. And this was, the geniuses, the technology geniuses started to take hold of Wall Street. Sometimes they would hedge the positions. They would be buying stocks and selling calls or doing interest swaps with them. The first time that we really saw the possible problems was in the 1987 market break. And that showed the weaknesses of the new systems. A lot of people had employed what they called portfolio insurance, which is no longer in business. It was started by a firm that did a terrific selling job, and it theoretically worked. But when it came under pressure, it exploded. And that had involved that if you wanted to get out of a market, you could sell futures against your positions. So if you thought the market was going to be weak, you'd sell the futures. They did not have the regulations that they have now. When everybody started to act the same way, theory disappeared, and we had that one-day terrible, terrible sell-off, which probably most of us remember. Well, after they studied what happened, they passed new regulations which gave priority to these small orders because they saw what the pressure of major orders could do to a marketplace. On the New York Stock Exchange, they gave priority on the dot machines to orders, I believe it was under 1,000 shares, while the larger orders, if they were going to distort the price of the shares, were shunted aside for a few minutes till they could get matching orders on the other side. On the NASDAQ, or as we know it, the over-the-counter markets, the market makers in the 87 crash could not handle the volume, and some literally shut down. They stopped trading because all the orders were on one side, sell. And these people just could not keep buying stock. So you had this great volatility in the marketplace. Well, when the experts, and there was a Brady Commission report, studied what had happened, they passed new regulations. And they required the market makers in the NASDAQ markets to make a continual market of either 500 or 1,000 shares on both sides of the market, bid and offered. And if they wanted to retain their status as a market maker, they had to make a continual market. Simultaneously, the small order execution system, called SOES, was developed. This is an electronic delivery system which goes directly to the market makers. You can see what each market maker, since you have competing market makers in the same stock, were bidding or offering, and you could direct your orders directly to that market maker. Initially, these machines were used on the desks of the Wall Street firms. But then traders acquired the same technology, and they started to make markets. And those people that were picking off markets were called the SOES bandits, because they would see that they could grab an eighth of a point here by buying from one firm and selling to the other. They could get the discrepancies and profit from them. Since in the NASDAQ markets, many large stocks had many market makers, there were price differences between the market makers. And this is what made this electronic SOES machines very, very valuable. But in some cases, these people were too smart. And that's why they were called SOES bandits. They would break up a 5,000 share order and just into 5 1,000 share pieces and just keep plugging away so that they had the advantages of the small market, the rules for the small markets, but they were profiting from breaking up those orders. And technology continued to move ahead. Most of the new technology was introduced by discounters. because we didn't have the built-in traditions. For example, the first technology that was introduced was execution by touch-tone phone, where you could place your orders by a touch-tone phone. And that enabled a reduction in commissions. You could get quotes and you could place orders by it, and you could get a report on what your portfolio was. This was probably introduced 10, 12 years ago. Then the next one was orders by personal computers, which enabled the firms again to reduce commissions. They bypass the traditional brokers. And if you follow the industry, discount brokers are fully registered. They have all the licenses, but they're paid a salary. They're not on a commission basis, as are the brokers of the traditional Wall Street firms. And these developments paved the way for Internet trading. It was first the touch-tone phone, it was the PC investment, and it was the those were basically the first time electronics were used in order handling. And this trading is exploding. My firm does around 50% of the executions day in and day out electronically, predominantly on the web. You know, I was not born with a mouse in my hand. But I realized 5 or 6 years ago that technology was either going to be my friend or my enemy. And I decided to try to make it my friend. Now, I will tell you that when I decided that, I had a computer set up on my desk. I had a tutor come in, and I took my first lesson, and the kids in my office were joking around. You know, the clerks are 22, 23 years old. They can't spell, they can't read a name, they can't pronounce a name, but they can sit down at that machine and it talks to them. So they were teasing about, look at the boss. She's learning what we know. So I realized that couldn't go on forever and a day. So I had a computer set up at my apartment and finished my lessons in my apartment because I was not going to be laughed at again, especially by employees. And so I realized, you know, and this web has revolutionized the business. In fact, I think of the web as the equivalent of the Industrial Revolution. It will change our lives in all kinds of ways. It has already, and that change will accelerate. You know, the quality of information available free from websites and independent information like Edgar. Edgar is you can get the information that is released by the SEC when the companies file it. It has leveled the playing field. Individuals can get information at the exact same time as institutions. They have to be on the site at the right time, and in addition, you can get information on companies, on the industry. You can get charts with a click for nothing. I mean, the websites are designed for that. And it's remarkable because it is independent research. Unfortunately, it's also become a little haven for the chat rooms where there is no accountability. People who own stocks who want to sell will often put out stories on how good the stock is, and they're selling while the public is buying. And that gets into freedom of press, and there's a big issue on that, which would take us through lunch and dinner, frankly. And you know, the NASDAQ markets became a natural place for traders since many of the technology companies are traded there. When they go public for the first time, they go on NASDAQ. They're new technologies. They're familiar with the NASDAQ markets, and many of them, like Intel, have remained. Microsoft, Lycos, I mean, they've remained on the NASDAQ markets. They have not moved to the big board yet, and may never. And the electronic developments, for example, the individual traders today, if you're trading at a lot of firms, you can get access to level 2 quotes, which means on your screen you can get the current markets that each market maker is making and direct your order to that market maker. So you're bypassing the traditional sources. And if the ads in the newspaper confuse you as to which system has which feature, I will tell you they're changing every day. The change that is going on in the market is incredible. Internet trading has revolutionized the market. We all use what they call a rules engine, and we can adjust the rules accordingly. The rules engine determines which orders go directly to the marketplace and which require approval by a manager. When an order comes in, a computer scans the order and scans the account simultaneously. Takes a fraction of a second. If the order fits the criteria that is set up, it goes directly into the marketplace, not touched by anyone. Now, that criteria can be the size of the order relative to the size of the account. Is the stock a speculative stock, like a penny stock or a $2 stock, and you see the size of the order is not right? It can be too many shares of a low-price stock. It can be, for example, ours is set up so that if you put in a sell order, it scans it to see is the stock in the account. Because if it's not in the account, that order is a short sale. But that's another subject. So we develop rules engines that fit a certain criteria. And that determines, as I said, which orders go in automatically. Nobody sees them, nobody touches them. And if it doesn't meet the criteria, it gets beeped over automatically to a manager that looks at the order, looks at the account, and will push a button, send, which puts it in play, or they say no. And if so, the customer is contacted. Now, that's the background. This has created the opportunity, all this, the electronics, for the day trading firms, who are not my favorite people. They are, well, you've read the stories, and I can tell you about a personal case. I have a trainer at 6 o'clock in the morning, 2 or 3 mornings a week. And he came in one day and he said, "What's day trading?" He said, a friend of mine, I went to college with him, is closing his photography business to become a day trader. And he explained the profile, married, 4 children, mortgage, house in Westchester. And he said that he has taken a course. Well, the day trading firms will charge you for a course, and it's usually 1 weekend or 2 weekends. And they'll charge anywhere from $1,500 to $5,000. Then you go and you trade, quote, on paper for a week. And Mike said, you know, he made $8,000 last week, and now he is going live. So he went live, so to speak. 2 weeks later, Mike came in and said, shall I loan him money? He went below the $20,000 minimum, and he's called me for money. I said I wouldn't touch him. Well, he borrowed money from friends, and then he came back a month later and borrowed again. Now, this is what's happening, and it isn't right. But it's technically legal. Some of them are operating by legal loophole. They loan customers money or arrange for loans when they get a margin call. You know, a margin call is determined 2 ways. There's a house call, and if your equity, in most cases, gets below 35 or 30%. And initially, you need a 50% down payment. You can borrow 50% of a purchase of stocks, listed stocks. If your equity goes from 50% to 30 or 35%, you're going to get a house call which says put up more money, either securities, cash, or bonds, and you have to keep the equity at a certain level. If it gets down to 25%, it's a Fed call. That's the Federal Reserve, and we have to sell out enough stock to bring that equity up to 25%. Well, about 4 or 5 years ago, the laws changed, and they enabled Wall Street firms to arrange loans. It was started for institutions, not individuals. So some of the day trading firms, if a customer goes below the Fed call, will arrange a loan from another customer, charging a fee and a pretty high rate of interest, and really sidestepping the intention of the law. Some of them are allowing short sales on downticks. Here again, that's a violation of the rules, and it's an interpretation that they are using. The short sale rules were started years ago in order to prevent a bear raid on a stock. And it said that if you want to short a stock, which is selling a stock you do not own because you think it's going to go down, you must do it on a plus tick or a 0 plus tick, which means if the stock is trading at 62, you would have to short it at 62 and an eighth or a 16th. And a 0 plus tick would be after it's ticked up the same price or higher. And they have violated certain of these rules because they are interpreting that if the clearing firm owns stock, has stock, possession of stock in margin accounts, they are long the stock. So they're allowing short sales on downticks. And, you know, this is what's happening now with some of the day trading firms. Almost every day we hear about an ECN, an electronic crossing network. These are electronic systems that all the orders are funneled into to try to cross it, so it doesn't go to an exchange. And there are 4 or 5 that are operating now. One is Island, owned by Daytech, Archipelago, Fidelity, Schwab, and Spearleys and Kellogg have announced the formation of another one. And there are 3 or 4 that are operating now. You can see the ads in the paper. Now, the purpose is to cross the orders in-house when you can. Get the order flow, cross it. And they have applied. The SEC now has applications from these electronic crossing networks. Goldman and Merrill have pieces of a couple of them. The purpose is to cross the orders in-house, probably make more money on it. But the problem is they have now applied to be stock exchanges, and those applications are in front of the SEC now. Originally, they were put into effect to extend the trading hours, which is also happening now. We will probably see 24-hour-a-day trading within the next couple of years. Now, the problem with having 4 or 5 or 10, I believe there are 10 or 12 announced ECNs now. If everybody has an ECN, will General Motors trade at 4 or 5 different prices at the same time, depending on where the customer is? If that's the case, we stand a risk of losing the confidence of the public. I had expressed this, and last week it was announced that 4 or 5 of the leading ECNs have announced that there will be transparency. So if the best bid is on one system, you'll be able to see the different bids and offers on the different systems. They did not say yet that if there is a better offer or a better bid, that the order will go there. But the first step is that there will be a transparency. Simultaneously, while all this has been going on, the New York Stock Exchange announced that in order to compete, they're going to go public. And that produces some major areas of possible conflicts of interest. Can the New York Stock Exchange remain a regulator and be a public company? Public companies have an obligation to shareholders to make higher earnings. That's the goal. Will that be in the public's interest or not in the public's interest? I don't know. So far, the challenges is, can the SEC keep up? Can the regulators keep up with the new technologies? Can they? It's their responsibility. And Arthur Levitt is taking this responsibility very seriously. But it is a broad imperative because we have to keep up, and you have to guide this system, combining regulation with new technology. Because, you know, our capital markets are really a national treasure. They're the envy of the world. And I think they have helped, I know that they have helped, create our economy. Because we've had these entrepreneurial geniuses. You may not like Microsoft, but Bill Gates is certainly an entrepreneurial genius, as are the people who founded Intel and the new media companies and the biotech companies and all these companies that are now contributing to the growth, the longest sustained period of growth in the post-war era, and the increase in productivity. And this is our challenge. We have to make sure that our capital markets continue to function in the same way and raise money for the new entrepreneurs of the future. What is another challenge? If the new ECNs are granted the privilege of being a stock exchange, they have to have the same obligation to the public that the NASDAQ and the stock exchange has had. You know, we have great public participation in the markets today. The public has gotten spoiled. They've seen the markets go up 20-25% a year. They expect a return on their business. A recent survey and study showed that the public has more money in stocks through their IRAs, 401ks, direct ownership, than they have equity in their homes for the first time. And that's a responsibility when you look at the American public that way. These developments are moving at a very rapid clip and are going to shape the future of our capital markets in the future. And I think they have to be helped. I think there should be, before we just allow these things to happen, there should be a plan as to where things fit. And I wish the SEC luck because they have a mammoth responsibility. And I'll take questions if I have time, if you have time. Governor.
Why shouldn't this eventually become just one big electronic market? Now, at least to keep it relatively simple, American stocks, stocks of our own nation, just one big electronic market. Couldn't they do everything that the various exchanges and ECNs and other devices are doing now?
There is no reason. We've all talked about this big black box, and that would mean, in my opinion, that we would need the Congress and the SEC studying this and arranging, because if not, we could have a very fragmented marketplace until the one big black box came into existence. You'd have to have different sets of rules for different sizes of companies. I don't know if you would want a stock that is now listed in the pink sheets that does not trade often on that same black box. I think these things have to be studied. I don't know if we would need some kind of capital infusion, because now the specialist system or the market makers do afford a certain, not a protection, but a leveling, because they are forced to make markets. A black box wouldn't make a market. It would just work automatically, so you could have more volatility in stocks on a daily basis. So I don't know how you deal with that. But we're working towards that. The thing that disturbs me is it's happening in pieces, and I don't feel that Congress has addressed itself to where the securities markets are going. And but the black box eventually, in my opinion, is going to be the way things go.
And what the potential downsides are in terms of their interaction. I mean, we saw what happened in Asia, and I don't know what the risks are there, but the instability that can be created by not being vigilant on this is, I think, a great concern. I'm just interested in you having your lucidity on this.
Well, we need a lot of harmonizing. First of all, I testified to Congress after the long-term credit management problem, and I said that we need global securities regulation. We need a global margin regulation. The Federal Reserve, historically, if they saw too much speculation, raised margins. There are too many other instruments in the marketplace, so it really wouldn't become that effective. You have all the derivatives that are trading. You have your major institutions. Some of the hedge funds are domiciled abroad. So you raise margin requirements there, and they say, thank you very much. I'm in the Bahamas. I'm in London. They're exempt. So you need a global margins. You wouldn't have had some of the currency trading if swings, the money going in and out, had there been a 2 or 3% margin requirement on currency trading. You've got different clearing problems in different countries. Some countries were only clearing stocks once a month. So if you bought stocks today, it changed once a month, possession of them, electronically or not by certificate. So you need to set up, in my opinion, the same set of rules in order to have real global trading. I think what's happening now in Euroland will help. I was invited to speak, and I was in France a week ago last Friday when Paribas announced their new web trading, which is in 7 different languages. And so you can buy stocks in 7 different languages and have it clear through the same account. So you can buy stocks in different countries. That is probably the first step, which I can see growing. But we are going to have some, rules, so it's the same strokes for similar folks. Because otherwise you have different margin requirements. You just can't have that if we're going to have a true global marketplace.
A year and a half ago or so, the city, under the threat that the stock exchange might leave the city of New York, entered into I think by everyone's estimation, a necessary but very, very rich deal to keep the New York Stock Exchange here. And that would result in the building of a new trading floor, a much, much larger trading floor. Is that, I think most of us would agree that keeping the stock exchange here was very, very important to the city, and number 2, keeping it in the Wall Street corridor was very, very important to the revitalization of Lower Manhattan. But with all of this movement, and very rapid movement to all kinds of e-trading, is that large trading floor that will result from this agreement going to be obsolete sooner rather than later? Is it necessary?
Well, they're going to have to change the technology probably 5 times before it's ever built. I mean, it's moving that fast. And I was chuckling while this was going on because I could not picture a lot of the people I know going to New Jersey every day. I was ready to sell them subway passes.
Who's in charge of educating?
Honor graduate at Harvard Law School, counsel to the Senate Judiciary Committee, and judge to the First Circuit Court of Appeals. They don't necessarily provide a true insight
I don't think they have really, truly addressed it. And that does concern me because this is a changing of the securities regulations and the industry. And there is no education that is unbiased. And I think you need a study of the markets in order to design a new market, to guide it. But the technology is moving so fast.
Since the last market disruption, and the safeguards were put in to make sure that you didn't have calamitous results again, all of the things that you're talking about have largely come into existence. And I just wonder what your view is as to what would happen today if there were a market disruption. Say the Y2K problem turned out to be real and there were huge sell orders because all sorts of companies were in deep trouble. What are there safeguards today to protect against a real calamity, or is this untested stuff?
Well, we've had to spend some Saturdays in the office testing systems. We don't do our own back office. We clear through Fidelity. But we still had to keep people in the office as systems are being tested. So the stock exchange has done as good of a job as can be done, I would say, under very trying circumstances, because the systems are, my firm, for example, I'm sure other firms did, we changed every computer last year to make sure it was white, so every computer's Y2K compliant. We just decided it was cheaper to do that. A lot of the systems, I think if we're going to have problems, it'll be because our European counterparts or counterparts in other countries are not as compliant as hopefully we will be. I don't see that kind of a major sell-off. If you have information that I don't have, I'd be delighted to get it.
If I did, I wouldn't be listening to you.
Yeah, that's right. I have said if that happens, I want to be in maybe Australia without a cellular phone. I guess it's time to go to work, Brian?
Thank you, Muriel Siebert, for that wonderful presentation. If you can't remember what those 4 words are that end in K, I understand this morning's presentation will be rebroadcast on WVOX 1460 AM this afternoon at 4 o'clock, and also this evening at 6 on WRTN 93.5 FM, courtesy of good friend Bill O'Shaughnessy and the Whitney Radio. We'd like to thank Muriel Siebert again. We'd like to thank all of you for coming. If his schedule holds up and we don't have any more hurricanes that he has to cover, hopefully Dan Rather will be with us next month. And we want to wish you a great day, and thanks a lot for being with us today. Bye-bye.